Hello, everyone. Welcome by Prometeia. Thank you all for attending our webinar about the current challenges in model risk management, possibly at a time that is furtherly challenging the soundness of risk models in banking. First of all, let me thank our speakers, starting from Dr. Joseph Breeden, board member at Model Risk Management International Association and co-founder of Deep Future Analytics. Welcome, Dr. Breeden.
Thank you. Thank you for having me today.
And many thanks to Sid Dash, Research Director at Chartis Research, who will help contextualize the main trends in model risk management. Welcome, Sid.
Thank you. Thank you for having me today.
And welcome to Suresh Sankaran, Head of Model Risk Governance at Metrobank in UK. Welcome, Suresh.
You're probably on mute.
Okay, you're probably on mute, but...
Good afternoon. Pleasure to be
yes.
here.
Okay. And the introductory speech will be held by Prometeia's Head of Risk Integration Competence Line for International Markets Europe, Tiziano Bellini. Welcome, Tiziano.
Thank you very much.
You will also be moderating the roundtable, that is the core of the session. The webinar will have a final part dedicated to Q&A, so I invite you all to type your questions in the questions section of the panel. You should see on your screen. We'll try to take as many as possible at the end, and for all other questions, of course, we will reply individually. So it's time to start. I leave the virtual stage to Tiziano for his presentation, and thank you, and speak to you later.
Thank you very much, Massimo. And let's have a quick resume of what Massimo was just mentioning. This is the agenda for today's webinar. We'll have a very quick introduction about Prometeia experience in model risk management. Then we will have a roundtable with our colleagues, and the final 10 minutes will be devoted to Q&A. So as mentioned, as Massimo was mentioning, would kindly invite you to post question to our roundtable participants. Well, a very quick introduction to model risk management can probably refer to the so-called model trace, and the journey about a model can be sketched in terms of the initial definition of a model proposal, then implementation of model package, validation package, and then implementation of the model, and then the approval and the subsequent monitoring and periodic validation until the model dismissal. And based on this life cycle of a model, at Prometeia, we have been organizing our solution in two main tranches, which are strictly interrelated one to the other. So we do have a model lifecycle management solution that mainly focuses on the identification of a risk by mapping the risk that can negatively impact the model life cycle, and then sources that may be related to model documentation, validation reports, and so on and so forth. And we do have a control section or control pillar, which is related to the defining and then implementing controls to minimize the model risk previously identified. And then we have an overarching governance to set limits on the acceptance of model risks in terms of both control effectiveness and then quantification of the risk, which is mainly, at least in this context of the model cycle management, a qualitative type of assessment. While on the other hand, we have been active in trying to implement some quantification of the model risk, given that for the vast majority of processes, models are quite extensively used. We have been attempting to quantify their impact from an individual or a silo perspective, as well as from a portfolio point of view. But let us try to highlight the key building blocks of Prometheus solution across the model cycle management. So we have been implementing a solution which is based on a few fundamental elements. First of all, templates, definition of models and data structure, and mapping of the relationships. And then the inventory, which is fully customizable, and it is substantially capturing all information relevant for a specific model and its corresponding application. And then we enter into the process context by defining role and responsibility by means of a dedicated workflow. And as it is fundamental from a managerial point of view, an enhanced dashboard allows us to fully represent the life cycle of the model by pointing out potential areas of weaknesses and potential need for intervention. In that respect, we can have a very, very high level view of our solution by highlighting that in templates, in our in Prometheus, a proprietary solution, a template, what do we have? We do identify a model type, sources that are used for informing the model, the status of the model, where it has been approved or it is still in development, whether there have been some validation or not, and so on and so forth. With respect to the inventory, how did we tackle the issue of representing an inventory? Well, templates are flexible. The user can define as many templates as it is required in order to structure all relevant information for each specific model. So we'll have a model ID, description of the model, the version, where this model is in terms of the life cycle phase, its corresponding performance, whether the model is achieving the minimum required standards or there are some issues, the materiality of the model, and many other information or related information to the specific model. Of course, we can refer to one specific model or we can refer to a portfolio of them, as an example in the case of models that do produce an ECL figure or an RWA, and so on and so forth. As we anticipated in the previous slide, roles and responsibilities are crucial. And so we, in our solution, we do define a workflow, which is represented by means of interactions between people and IT solution or models, a series of embedded models, and so on and so forth. And for each specific step of the implementation of a model, the platform does highlight roles, tasks, and corresponding outcomes until coming to the actual workflow, which is representative of what happens throughout the life of a model. Of course, as the template, inventory, and roles and responsibilities, each workflow is fully customizable, and it is strictly related to the type of model we are considering. Is it a model which is used for credit risk purposes, or for financial planning, or for monitoring IT risk, or applicable in the context of an audit? Well, our solution is indeed covering a series of potential use cases that go potentially beyond the typical classical model risk management. And according to our experience, it has been implemented and applied in many other contexts. A very quick overview in terms of reporting. What do we present in our solution? Well, we do have an immediate reporting and documentation representing the tiering, the role of each model, or how many models are in each status in terms of development, approval, monitoring, and so on and so forth. What is particularly relevant, we will probably pose some questions on that to our panelists. What is particularly relevant from our perspective is the summary of findings related to a specific model by means of a model risk index, which then fits the so-called representation of residual risk. So we can potentially have a heat map representing and highlighting which models are the most relevant from a risk point of view, and which one needs to be managed with specific importance given their tiering and given the number of findings related to them. And now we move to the quantification point of view, to the other main pillar we were discussing earlier. Very briefly, how I've been operating in that respect. We have been organizing the model risk quantification in terms of splitting the key pillars for quantifying model risk by highlighting the role of model selection, potential estimation errors, and then implementing sensitivity analysis by taking into account both internal as well as external conditions. And the four main step is related to the fully integration of different processes. As an example, the balance sheet projection for stress testing, or ILAP perspective, or the RWA projection. In that respect, we are completing the entire circle linking governance, control, identification, and quantification in order to feed, how to say, some sort of model risk appetite. And for each specific model or for portfolio of models, then we are capable of defining ex ante a appetite for model risk and then monitor it accordingly. We are then capable of populating a dashboard like this one, where for each specific model or for portfolio models, we are in a position of making a comparison between ex ante and ex post assessment, and whether in the case where we go beyond some risk appetite threshold, then a red flag status is going to pop up. Very quickly, just to mention how we have been operating in the sense of full integrated balance sheet, as you may imagine, for a complex process like a stress testing or a balance sheet planning, many models do interact each other. And the noise of each component can potentially create additional noise once this model or one model is studied or is used in conjunction with other models. And these graphs, they do represent the potential impact of PD, LGD, EAD uncertainty across different portfolios and over a certain time horizon. We can, as an example, highlight the role of including or not macroeconomic variables uncertainty in our projection as it is described on the left-hand side, and introduction or not of correlation as it is represented on the bottom right hand side of this slide. So all in all, the aim of this very, very short introduction was to highlight where Prometea has been experiencing solution in the context of model risk management with a different flavor or a different emphasis on the one hand on the model governance or model life cycle, and on the other hand on the quantification of the corresponding risk. Well, this very, very short introduction paves the way to our roundtable. Once again, we would really like to thank our panelists to have taken the chance and the challenge to participate to this roundtable. In that respect, I'd really like to start by asking Sid Dash his experience in the validation technique with a specific focus on the market risk on the one side and on advanced analytics, machine learning, artificial intelligence on the other. So which is the role and how the validation techniques have been evolving, and which is their corresponding relationship with model risk management?
Well, I mean, validation techniques, as we all know, sort of go through a whole range of qualitative, quantitative, and final reports. But if you look at validation techniques in the sort of broadly market risk sort of environment, broadly, it's the OTC derivatives area that has been the most sort of mature, principally because the model framework of OTC derivatives allows a wide range of parallel approaches, alternative systematizations, etc. For example, you don't have to just check the whether the inputs are producing unreasonable outputs. You could also look at things like a hedging strategy and look at the overall cost of hedging and look at how effectively you're able to reproduce products. And because of this sort of dual link, underlying product, a market framework that links the underlying product with the price and risk of the given assets, and in a fairly unambiguous and clear way, it becomes a lot easier to stress test it, provide alternative mechanisms of test, and that's why there's a whole range of parallel techniques from a best practice perspective. That's very, very mature sort of framework. It's also been probably one of the earliest areas to have sort of validation. But one of the things that we also see there is that a growth of a range of tools. So increasingly, we see validation getting more industrialized, and we see a growth of range of tools which allow you to control, manage, and probably accelerate the process of validation in derivatives, in futures and options, in a whole range of market risk oriented products over there. Now, moving to looking at sort of using machine learning and advanced analytical techniques, I think there are some obvious parallels, but the structural challenges in advanced analytical techniques revolve a lot more around the issues of underlying data and regime change. What happens when the nature of the data changes and you're applying the machine learning model over that period of time and so on. Again, one of the phenomena that we see here is a growing focus on standardization and industrialization of the mechanics of how validation occurs on machine learning frameworks. Now, again, machine learning frameworks can range from a very fairly simple, rather fairly domain constrained problems, which look at optimization of something, looking at the correlation of a range of data sets, or they could be full-fledged frame structural models looking at forecasting forecasting future prices, etc., etc. Our view is that each of these type of models has slightly different challenges and requirements, but fundamentally the main challenges sort of boil down to data appropriateness, regime shifts, for how long are you able to ensure that the data available to the machine learning framework remains consistent with the way it was originally modeled. This gives rise to a slightly different process of industrialization, but essentially focused on the idea that of the data availability and continuous sort of testing of the machine learning frameworks against the data availability that sort of potentially exists out there. So we think both sides, that is the traditional market risk sort of models and the newer machine learning models, etc. We are seeing a trend towards standardization, industrialization, and a structural framework of accelerators to check how the validation is taking place. So it's not entirely a process of human inputs in both these sort of cases. It's increasingly a process of leveraging your accelerators and tools because you have a standard set of frameworks involved. The dimensions of those standard sets are somewhat different. In one, your dimensions of building standard sets includes things like alternative approaches of looking at the risk, that is ability to synthesize an instrument, the ability to look at synthesize the same market risk position and so on, and hedge cost analysis and so forth. And on the other side, it's really looking at the data evolution and ensuring a link between the data evolution and the AI model that has been used against it. So the frameworks of industrialization and standardization are somewhat different, but I think the trend is very structurally towards industrialization and standardization on both sides of the fence. And hence, from a validation perspective, we're increasingly seeing validation being surrounded by systems and automation and tools, if you will. So increasingly, there is a little bit of a convergence between the overarching governance principles and the validation management tools. And obviously, at no point can pure conceptual validation be sort of fully industrialized. But the vast range of validation processes, standardization of that means that it is increasingly something that can be leveraged by the tools framework in the rest of the governance and management area, if you will.
Thank you very much. I don't know whether Suresh or Joseph, do you have any comments in that respect? A very, very quick comment.
Yes, thank you, Tiziano. The one point that I would like to make is the incorporation of such advancements in validation routines is more than welcome. And it is something that is going to improve the accuracy. It is going to improve the efficiency of the validation process. However, I am hesitant to bring a fly in the ointment, and that fly in the ointment is the regulator. At this point in time, neither the European regulations nor the UK regulations have any specific statements aimed at addressing the increasing use of machine learning techniques or artificial intelligence techniques in the validation process. And therefore, the sooner the regulators are pushed to enshrine such concepts into regulatory framework, the better these models will be accepted, these techniques will be accepted. Tiziano.
Thank you very much. Well, we will have to talk to the regulator more and more in that respect. And well, I think very, very connected to the topic related to the validation. How do you see the model risk governance? In the last few years, we have been experiencing new trends in terms of role and responsibilities of validators or internal model review, and the model risk management. So would you like to present your experience in that concept? How do you see the department of validation and model risk management going along? Do they refer to the chief risk officer, or are they independent, and so on and so forth? We will be very, very happy to understand and to hear your view.
Okay. The problem that arises is primarily because of the reporting hierarchies being completely different from responsibility allocations. So, who are the principal players in the model risk management framework? You have the model developers, you have the model monitoring team, you have the model validation team, you have the model implementation team, you have expert panels that are convened on occasion to discuss and opine on specific issues that may come up. And then there is the overarching governance framework. The model development team, more often than not, is sitting within the first line, which is the operations. It could be market risk operations, it could be credit risk operations. Validation is a standalone unit, reporting perhaps to the CRO, perhaps to prudential risk. The model maintenance is again partly enshrined within the various units that are contributing to the P&L process. The model implementation team is completely away from all of this, is sitting in IT, and therefore, because of the responsibilities being completely different, there exists some confusion in terms of what should be the appropriate structure for governance. And in all of this, where does model governance itself fit in, other than model validation? So we'll take each one at a time. This is where the term fungibility becomes a reality. These are departments and teams that are working to their unique responsibility allocations, but at the same time, they are coming together, just as you pointed out in your presentation, Tiziano, through a holistic model risk out workflow, a structure that seamlessly takes into consideration information from a business case being brought into model development, and then that process seamlessly moving towards model review and monitoring, and then validation coming in. And this could be from a completely separate unit or within the model governance framework, using the tools and techniques that Sid talked about to incorporate in the efficient validation of these models, and then an overarching secretariat and governance function that is provided by model risk governance. And so this workflow is absolutely important. Without a structured workflow process in place, it is very difficult to identify who does what and who is responsible for what. Now, coming to the reporting lines, I don't think that validation should sit anywhere within the operational framework, and that is what I have seen in my experience. Validation, like internal audit, is a distinct, subject matter expert intensive, separate, accountable entity, and that should report directly to the CRO. If not to the CRO, it should report at least to the head of prudential risk if your organization has a prudential risk function. And this is to ensure that there is the element of independence that can be clearly identified to the validation framework. Without this independence, validation is already compromised. More so, given the fact that the fungibility that I talked about is in existence all the time. Departments are reporting into different levels within the organization, and therefore the structure of seniority, organizational hierarchy might come into play. And therefore, to avoid all this, it is my recommendation that validation sits in a complete vacuum, just like internal audit. To my simplistic mindset, the approach that validation takes is rather akin to the internal audit framework. So they are coming in as an independent body, they're evaluating the process, they are opining on the efficacy of the models that are being developed and the usage of the models that are being developed, and therefore they need to be independent. The others, it doesn't matter where they sit, whether it's model development, model monitoring, model implementation. Typically, model implementation is aligned to the infrastructure within the organization. But more interesting question for me also is, where does model governance report? I mean, should model governance as with model validation report into the CRO, or should they report into the prudential risk? I mean, typically, I've seen that it is usually the latter. Model governance frames reports into the prudential risk framework. They are responsible for the smooth oversight of the overall workflow process. And again, I draw reference to your very, very well-structured presentation, Tiziano, where you pointed out how this workflow should work through.
So thank you very much, Suresh. And I'd really like to hear the view of Joseph in that respect. Well, in Europe and in the UK, the validation unit has been established for quite a long time. But in the US, this model risk management has been created or proposed by the Federal Reserve more recently. And at least in Europe, we are a little bit puzzled on the distinction and the role of validation and the role of model risk management. Which is the scope, according to your view, your experience, of model risk management compared to the internal validation?
I think the main point to make about the US market is that we have 15,000 regulated banks and credit unions. And then, of course, we have a large number of mostly unregulated finance companies. And so there is no one-size-fits-all approach in the US. Many $10 billion and below organizations have models. They'll have some internally developed models. They'll have lots of vendor models. And they have little or no process about how to manage those. As you go up from there, 10 to 50 is where you see emerging practice people developing an in-house validation team, but immediately you run out of executives. Who should that team report to? Too often, just because there's no one left, they'll wind up reporting to a CRO or someone who has a vested interest in the models being accepted because they're also in charge of creating the models. So smaller organizations just struggle with not enough chiefs for separate reporting. When you get to the largest organizations, this is pretty well established. I don't think you'll find any organizational problems at JP Morgan and some of those, but we see a lot of challenges that are difficult to deal with, difficult to manage as you go smaller. I know at MRMIA, one of our board members, Tom Dolan, works for one of these about $20 billion banks and has a lot of experience with vendor models. And he's constantly complaining that in an organization his size, he can't get vendors to provide a suitable documentation. They always say, sorry, that's intellectual property, that's trade secret. And smaller banks don't have the clout to force disclosure. So those are the main challenges I see. What we're trying to do is, at least when it comes to vendors, and I myself am a vendor, so I'm speaking about how to manage people like me, but there's a certain collective action that's required, right? Where enough clients are asking for it that people are forced to. In fact, we try to be proactive about that and say, we know this is required, and so we just publish everything. I think that's what all vendors should do. In this kind of space, yeah. But I don't have an answer for that kind of, call it anywhere from 5 billion to 50 billion range, where they just don't have enough executives for a clean reporting hierarchy. Other than there may be additional cost with hiring executives who have a reporting structure like you might find at a larger bank, but they haven't largely done that yet.
Thank you very much. And I'd really like to continue with you, Joseph, on a topic which is particularly relevant in Europe over this period, where substantially all banks have been asked to perform a climate stress test. So how do you see, from your experience, from the experience of Model Risk Management International Association you do represent, how do you see model uncertainty in this climate change? In my presentation at the beginning, I was showing a full integrated balance sheet uncertainty representation, where this process is particularly challenging. So we would really like to hear your view in that respect.
Mm-hmm. I think one has to step through carefully on the various uncertainties and what they mean for an organization. I would start with the uncertainty of just, this is scenario based, because just like I can't predict the economy next year very well, given global events, I also can't predict climate 20 years from now very well. I'm originally a physicist. I understand those who complain about the unknowns in these models, because long-range forecasting is inherently difficult, but that's not an excuse for doing nothing. Just like we have economic uncertainty in our portfolios, and the economic impacts are often highly uncertain, but that doesn't mean we do nothing. It means you have to run scenarios and look at a economic capital-based approach, things like that. So when you want to take an institution and assess the risks and uncertainties, I'd have to say that most of what I see around climate change is a discussion of collateral, homes, cars, businesses, the physical structure being damaged. And from a lending perspective, which is the work that I deal with, the collateral should always come with insurance. And in fact, there are products, even if you're an auto lender and you can't guarantee that every one of your borrowers maintains their auto insurance, there is supplementary insurance available for the uninsured. So the lender doesn't need to bear collateral risk for home, auto, that sort of thing. I think the risks we should focus on are the more subtle ones, which is that if there is an event, how does that impact other loans that they have? Or it's worth pointing out, I guess, we see this in auto lending a lot, that if someone wrecks their car, they may stop making payments. And when collectors call and say, why have you stopped making payments? It's like, well, the car is destroyed, so why should I make payments? There is often a lack of understanding that the money is owed regardless of the status of what you borrowed against. So there are always defaults of that sort, even when people can pay, related to destruction of homes and cars. We have a lot of hurricane data that we can look at. But the ones that I would want to pay attention to in the US, where we're looking, is agriculture. That droughts and a new word for all of us a couple years ago, derechos, which is intense hurricane-like storm events in the middle of the country where there is no hurricane. There are a number of events like these that are doing damage to crops in unexpected ways. And of course, if you're a farmer or part of that supply chain, if the crop is destroyed, then you're likely to default on a credit card or a mortgage or something else that wasn't directly impacted. So these secondary effects, I think, are important. And of course, that just means we would need to understand the chain of risks. You know, climate scenario leads to a lending event, which then leads to a potential loss. Now, with any scenario-based thing, people want to ask, what's the probability? What's the probability of a drought across the U.S. Corn Belt severe enough to cause large-scale defaults? Well, it's about equivalent to looking at somebody's economic scenario and asking what's the probability of this. It's not a well-posed problem. In fact, it's very difficult to quantify that. So we're going to run these scenarios, but there's wide uncertainty in the outcome. Some have made a very useful point, which is that if you look at US hurricane data, it hasn't actually led to bank defaults. It's led to consumer defaults. But even in a highly correlated event like that, the banks themselves have enough collateral and insurance that we haven't had bank failures as a consequence of hurricanes. So that doesn't mean we should ignore the problem, but from a lending perspective, it may not be as severe as we think it could be. Now, as an individual, I'm very much concerned about climate change, and I've actually done some of that modeling myself in past years, looking at tree rings and whatnot. So I don't want to dismiss climate change at all. I'm just saying that it may not be worst on banks, but still, we'll have to go through this exercise to understand those risks, of course.
Okay, I thank you very much for your very comprehensive representation of these model uncertainties related to climate change. And at this stage, I'd really like to go back to Sid by asking him which is his view from a very peculiar perspective, from a Chartis perspective, that is scrutinizing a series of professional firms and so on and so forth. Which is the current status of the model risk management from a holistic point of view? So stated differently, in the context of credit risk, we might have a model which is aimed at producing probabilities of default, another loss given default. But what do banks do in order to represent the uncertainty of all of them together? This will be very, very interesting. for having the overarching view from the UK, from the Europe side. I don't know whether you have some hints on the US as well.
You're on mute, sir.
Yeah, aggregating model risk across many risk types is inherently challenging. I mean, when you think about aggregating model risk across a portfolio itself, of a portfolio of credit or a portfolio of financial assets, you start to aggregate a certain degree of uncertainty across all of that. And then when you start to think about aggregating model risk across a broad portfolio, you started to look at a range of uncertainties that sort of build up. But we think that there are several mechanisms to look at sort of the more holistic or more portfolio effects of model risk, if you will. That includes uh, statistical and sort of not exactly novel, but increasingly interesting methodologies like reverse stress testing and stress testing itself, but reverse stress testing, where you look at working back what different scenarios sort of are impacting the overall institution from different model failures or individual impact. How does that impact your model? How does that impact your risk portfolio overall? So we think there are three different ways of looking at all of this. One is when you're looking at model risk in a portfolio, you need to start thinking of. I mean, some of the boundaries and edges are obviously going to um, some of the boundaries and edges of your risk are going to be uh, uh, presumably reduced. And then when you think about model risk across the overarching portfolio, then I think the key dimension is to potentially use newer statistical techniques such as reverse test testing to start looking at the broad structural impact that may be introduced because you're looking at many different sort of model types, if you will. But it's still a very early stage sort of framework from our standpoint, and we're still seeing considerable evolution in the way institutions handle a more holistic view of model risk.
Thank you very much. Suresh, do you have any view in that respect?
Yes. From a, you think about what we are trying to achieve, and you correctly and very eloquently pointed this out earlier. You have, say, for example, models that are used to quantify risks relating to residential mortgages, perhaps. And within that, you're looking at probabilities of default, you're looking at loss in the event of default, loss given defaults, and you're looking at exposure at defaults. These three models are essentially part of a ratings mechanism. They, I postulate that these, rather than being looked at on an individual basis, they all act on the same basis or on different bases using the same or different variables and work in a similar fashion on a same portfolio. So your model relating to residential mortgages, whilst having a distinctly identified PD, a distinctly identified LGD, and a distinctly identified EAD, behaves like a rating framework. And it is that rating framework that I think needs to be modeled going forward. So rather than a individual model, you're bringing together a cluster of models, or what I would call rating universes for specific asset classes. And the example is very relevant from a credit standpoint, because you are going to be quantifying for the same asset class the impact of PD, the impact of LGD, and the impact of EAD. And therefore, this, looking at a holistic view of not individual models, but a cluster of models becomes very important, and I believe will be the way forward. Increasingly, regulators like the PRA are asking organizations to not just look at models, but these ratings universes, Tiziano.
Thank you very much. Another topic I'd really like to very, very quickly discuss with you because of time constraint. We have the Q&A session. It's about the model risk index. As we were presenting earlier, our solution has a static, at least for the moment, model risk index representation that we are thinking to make dynamic. Which is your view and which is your experience at the Metro Bank and across the banks you have been working for in that respect?
If you think about it, a model is differentiated based on materiality, which is a static number. Model risk associated with a specific model is also a static number. However, what we have proposed in Metrobank is something completely different, which is a dynamic view of model risk index. So we take into consideration the model life cycle and understand at each stage where the model is, what is its riskiness. For example, if a model is 2 months late in its annual review, it poses more risk than a model which is on time. A model that is validated and has 5 significant validation actions is more risky than a model that has 3 significant validation actions. A model that is delayed in implementation is more risky than a model that is on time as far as implementation is concerned. A model that has significant post-model adjustments and overlays has a much more uh, uh, structured and nuanced framework of risk than a model that does not have such post-model adjustments or overlays. And therefore, at each stage of the model's life cycle, there is riskiness that ebbs and flows. And you need to have a model risk index that captures at each of these points the riskiness. And so you can actually showcase the evolution of your model. So as it started, what was its risk? 3 months down the line, what was its risk? And so you can actually put a timeline to it, tie it into specific deliverables within the various participants within the model risk framework, and therefore make this structure a dynamic and living and breathing framework. So whilst I applaud you for incorporating a model risk index within your solution architecture, it would be vastly superior if it were to be enhanced to incorporate this dynamic structure that I'm talking about, Tiziano.
Thank you very much, and thank you for shortening your answer in order to allow for a few Q&A. Well, we do have a series of questions. The first one, in the interest of time, I'd like to pose directly to Joseph, but then other panelists are very welcome in that respect. There's a question concerning events like COVID-19, the current invasion of Ukraine, and so on and so forth. These events cause a lot of uncertainty. How do you manage and how do you aim at quantifying the impact of these events that in many cases, as in these two specific scenarios, hardly are embedded onto the time series or the panel data on which you do develop your model?
It's a very good question. The thing I've just wrote an economics newsletter on yesterday. The headline was actually about coronavirus in China, because a zero COVID policy in the face of Omicron and BA2 is probably not sustainable. But they have political challenges with trying to change policy this year. So consequently, there could be rolling supply chain challenges because of places like Shenzhen, which is a manufacturing center, having reduced capacity. We don't know yet, but all these things mean that we could see, again, supply shortages, inflation, etc. And of course, I very much care about the war in Ukraine. Similar kinds of effects, except there, instead of finished goods, you're talking about raw materials, but it all feeds into the global supply chain. Again, I'm always looking from a lending perspective where you'd say these are drivers of scenarios. So we would increase the risk of recession, or even a stagflation type scenario where you've got a inflation and recession at the same time. So that's kind of the consumer perspective. Would they default on their loan? From a modeling perspective, there are clear challenges when things don't follow the usual patterns. And specifically, I try to think about the when we look at machine learning models in particular, a good machine learning model, one that is finding unique things, I always say it's finding pockets of predictability. It's finding behavioral patterns that a linear model wouldn't. The challenge with the economy does something that's not in the available historic data, those patterns will disappear. And so your machine learning model can be more vulnerable to sudden shifts than what the linear model is. And of course, we say these are learning algorithms, they can adapt, but they can only adapt once you have the outcome, right? And so if it takes a certain number of months for a default to occur in a new environment, then it's going to take that much longer to gather new data. So you could, as we saw in the pandemic, you can easily run 6 months without data on which to refresh your machine learning model. So it's my thesis is in techniques that are now called machine learning. So I'm not here to bash machine learning, but there are limitations. And that's where having backup models, linear methods that are based purely on finance and less on behavioral pockets of predictability, those sorts of things become very important in turbulent times. Sorry for the long answer.
Thank you very much. I don't know whether Sid and Suresh, do you have any further comment? I would envisage to have a 1 minute answer. Sorry for
I have a quick
keeping you
comment.
short.
I have a quick comment where I essentially agree with Joseph in the sense that having structural models does help when you have a situation of extreme shift, because it's possible to then test and create scenarios more rapidly and quickly, and test scenarios which follow from the model, from the sort of logic of the model itself, if you will. For example, if you have an option theoretic model translating into corporate default, it allows you to look at extreme points on that corporate default structure more easily and quickly.
Thank you very much. Suresh?
Very, very quickly, I just wanted to point out that all of these, macro events that you talk about have an impact on market factors, which in turn have an impact on idiosyncratic customer factors. And on the sideways, there is also the climate factors that are now being factored in from this holistic stress testing that you talked about earlier. And therefore, it is a challenge for the modeler to start thinking in terms of incorporating these variables and assessing and understanding these correlations in normal times and in troubled times, which may be completely different. And therefore, it is a challenging time. There is a Chinese curse which says, may you live in interesting times. And I'm afraid we are living in very interesting times right now.
Thank you very much. Well, we do have a series of other questions, but unfortunately, time is ticking. So I would leave the floor to Massimo for the closing remarks.
Thanks, Tiziano. Thank you also. Thanks to Dr. Joseph Breeden to Sid Dash and to Suresh Sankaran for their very interesting contribution. Of course, we will reply to the other questions afterwards. I also invite you to visit our website, www.promete.com, for our latest insights and releases on model risk management. Shortly after the closure of this webinar, you will be sent a very, very short assessment survey. So please have your say to help us improve for the next webinars. And then, of course, you can always contact us at risk.community@promete.com or directly to Tiziano Bellini's email address. So thank you all again, and hope to see you very, very soon. Thanks.
Thank you very much.
Thank you very
everybody.
much.
Thank you. Bye-bye.
Thank you. Have a lovely evening now. Bye-bye.
Okay.